Hello and welcome to this chapter overview video for chapter 4, where we're going to look at completing the accounting cycle. So our learning objectives for this chapter are here. The ones we're going to be looking at on the video have to do with preparing the financial statements, including the classified balance sheet. We're going to look at post-journalized and post-closing entries, prepare a post-closing trial balance. We're going to have a third trial balance now. And then describe the accounting cycle. So we're going to revisit and we're going to finally finish the accounting cycle, all of the steps. Okay, so remember that you remember the financial statements from the previous chapters, right? The income statement, the statement of retained earnings, and the balance sheet. And remember that where we left off in chapter 3 was that we had an adjusted trial balance. So we had prepared journal entries to record all of the transactions that happened during the year or the period, and then we prepared a trial balance, and then we made all of our adjustments and prepared an adjusted trial balance, and that's where we're starting now. So remember, we said the financial statements are prepared from the adjusted trial balance, so it's very important. Remember, these are all the correct numbers now. So our adjusted trial balance and all of our trial balances are in the same order. We call it financial statement order, starting with our balance sheet accounts, our assets, our liabilities, and our common stock, our equity, followed by our dividends, which go to our statement of retained earnings, our revenues, and our expenses. So notice how this is organized in a way that makes it very easy to prepare financial statements. Everything's right there in the order in which you need it. Okay, so let's review financial statements, and then we're going to throw in a little classified balance sheet, which is a new addition to the balance sheet, some new details. All right, so we always start with the income statement. And remember that the income statement has revenues minus all your expenses, and that gives you your net income. Generally, our expenses are in order from largest to smallest. Remember, we always have a three-part heading on our financial statements, and the income statement is for a period of time. This period of time is 2 months. Okay? When we get our net income, this goes off to the statement of retained earnings. This is why the income statement has to be done first, because you need your net income to go to your statement of retained earnings and calculate your ending retained earnings. So here we go with that 8550. We're taking it over here. In this case, this was our first couple months of business, so our beginning retained earnings balance is 0. We're adding the 8550 net income from our income statement, and that gives us a subtotal of 8550. Minus the dividends we paid out, which are 5,000, and that gives us an ending retained earnings balance of 3550. Our ending retained earnings balance is the one that goes to the balance sheet. Now be very careful. Let me tell you one of the most common mistakes that financial accounting students make, and I bet you will find yourself making this. When you look at an adjusted trial balance and you're preparing financial statements, your instinct might be, now of course in this case there aren't any retained earnings, but your instinct might be to take the retained earnings number from here, which would be your beginning retained earnings, and put that onto your balance sheet. But you don't want to do that. You want to take ending retained earnings, and the ending retained earnings goes to the balance sheet. If you ever have a balance sheet that doesn't balance, look at your retained earnings first. Okay, look at that first. All right, so our 3550 is our ending retained earnings, and we see that here on our balance sheet. Remember, the balance sheet is different from the other financial statements. The statement of retained earnings is for the 2 months ended. The balance sheet is a snapshot, a point in time. It is not over a period of time. So this is just December 31st, 2025. And remember, our total assets have to equal our total liabilities plus our stockholders' equity. Here are all our liabilities. Here's our stockholders' equity. Now we're going to take a look at a classified balance sheet. So we're going to put a little more detail here. Before, we had assets, only assets, right? And now we're going to take our assets and we're going to break them up into current and long-term. So our current assets are assets that are going to be converted into cash or used within a year or the operating cycle, whichever is longer. For the most part, it's going to be within a year, right? Our long-term assets, this branch really should be coming off of here, but let's just pretend that it is. The long-term assets have three different kinds, all right? So these are all long-term assets. Long-term investments, which would be things like stocks and bonds, property, plant, and equipment. This is going to be the most common. This is the one you're going to see. Pretty much every company has property, plant, and equipment. Property is land. Plant is building, if you own a building. And equipment would be all kinds of things like machinery and furniture and computers and vehicles. All of those things would be included in this category. And then finally, we have a category called intangible assets, which are assets that are long-lived but do not have any physical substance. We're going to take a look at those in a little more detail in the future. Now, our liabilities are also classified in current and long-term, but there's no other classifications. It's only current and long-term. So current liabilities are liabilities that the company has to pay or discharge within a year. So things like accounts payable. Long-term liabilities are liabilities that will be due in more than a year. All right, let's look at a classified balance sheet. All right, so we still have our assets, liabilities, and stockholders' equity, but now this particular one, we have current assets and we have property, plant, and equipment. They didn't have any investments or intangible assets here. So our only long-term assets are property, plant, and equipment. Our assets are still in order of liquidity, so we start with cash and accounts receivable, which is generally going to be collected within about 30 days, right? Maybe 60 days. Then we have supplies and prepaid rent, which are both going to be used up within a year. That gives us our total current assets. Now let's look over here. This is a little tricky. There are a lot of numbers here, right? So let's start with the land. That's easy. That's the cost of the land is $20,000. Now here we have the cost of the building. So the building was $60,000, and we subtract our accumulated depreciation on the building to get our book value, which is $59,750. Then we do the same with the furniture. We take the cost of the furniture of $18,000, we subtract $300 in accumulated depreciation, and that gives us $17,700, our book value for our furniture. So here we add the land, the book value of the building, and the book value of the furniture, add those three together. That gives you your total property, plant, and equipment of $97,450. We add that to our total current assets, and that gives us our total assets. All right, so this is the same as it was before, except it's broken up into two categories. Now let's look at our current liabilities. So our current liabilities are things you would expect to see here: accounts payable, utilities payable, salaries payable, interest, and unearned revenue. So all of those will be discharged within a year. You add up your total current liabilities, put them over here, and then we only have one long-term liability, which is note payable. Now notes payable can actually be short-term also, so you have to be careful, or current also, but here we have a long-term note payable. A lot of notes are long-term, things like mortgages. So we add our total long-term liabilities to our total current liabilities, and we get total liabilities. We add that to our stockholders' equity, and that gives us our total liabilities and stockholders' equity. Remember, these numbers have to be equal on your balance sheet. So our total assets are still equal to our total liabilities plus stockholders' equity. All right, next up, we're going to take a look at closing entries. So we're at the end of the period. We used our adjusted trial balance to prepare all of our financial statements. And now we're going to look at what the next step is in this process, which is closing entries. All right, imagine that your revenue account has a balance of $300,000 at the end of year one. In January of year two, you record revenue of $30,000. What will your revenue account look like at the end of January? Think about that for a minute. How much revenue have we had in year 2, right? All right. So let's say we had our revenue. We had $300,000 in year 1. Then in January, we recorded $30,000. Now we have $330,000 in our revenue. Is this an accurate reflection of the revenue for year 2? No, you must be thinking, no way, this is crazy. What's happening here? Our revenue in year 2 should be $30,000. We're not adding last year's revenue to this year's revenue, right? So we have to get rid of this $300,000. The $300,000 is last year's revenue, and at the end of that year, we close it out. Now, how do we get rid of it? Think about it. If we want to get rid of this, we have to debit this account for $300,000 to get rid of it, right? And that's what we're going to be doing. All right, so all temporary accounts, which are revenues, expenses, and dividends, have a zero balance, and those get closed at the end of the closing entry process. Okay, so we're going to close revenue, expenses, and dividends. They're all going to have a zero balance. Our permanent accounts, which are our assets, our liabilities, and our common stock, those are going to have stay, they're not going to get closed. Those are going to get carried forward to the next period. So for example, if you have $20,000 in cash at the end of the year, that's not going away, right? That amount of cash that was there on December 31st is still going to be there on January 1st, right? The revenues and expenses and dividends will not, but all of your permanent accounts are going to be carried forward to the following period. So the purposes of closing entries are twofold: to transfer the balances of all the temporary accounts into retained earnings. Remember that retained earnings is increased by net income and decreased by dividends. Remember that? So that's really what's happening here. We're actually doing it in the form of journal entries. We're taking our income, we're putting it into retained earnings. And then our second purpose is to reduce the balances of the temporary accounts to zero to prepare them for the next period, just like we saw with the revenue, right? We have to get rid of that old revenue to put the new revenue in there. All right, so the first thing we're going to do is close our revenue accounts to a very temporary account called income summary. So this is the example that we have been working with. So we're going to debit service revenue for $17,500 to close the account, and we're putting it into income summary. So we're going to credit income summary. So we close revenues by debiting them. Now we're going to close all of our expenses. Now remember that expense accounts have a debit balance, so in order to close them, we have to credit them for whatever the balance is in the accounts. And here are all of the expenses. So you have to do every one individually because each of these accounts needs to have a zero balance at the end of the year. So we're going to credit each of the accounts for the balance. And now sometimes students are mystified by this number, this $89.50. Like, where did that come from? And it is tricky because you're going to do your debit first and then all your credits, but you can't find the amount of this debit until you add up all your credits. Okay, so this $89.50 is the total of all of these expenses added up, and that is the amount of your debit here. So now what do we have? We have a credit to income summary for the amount of our revenue, and then we have a debit to income summary for the amount of our expenses. So our balance right now in income summary is what? It is net income, right? It is revenues minus expenses. So our third entry, the third thing we want to do now is to get rid of this income summary and put it into retained earnings. So we have net income sitting in our income summary. We're going to debit income summary for the balance that we just put in there, which is $85.50. And then we're going to credit retained earnings. All right, so we're putting our net income into our retained earnings, just like we saw on our retained earnings statement. Finally, we're going to close our dividends. Now again, dividends have a debit balance, so in order to close them, we have to credit them. So we credit the dividends and we debit retained earnings because we are reducing our retained earnings by the amount of dividends. Because remember that retained earnings has a credit balance because it's an equity account, right? And we're debiting it to reduce it because we know that dividends reduce our retained earnings. All right, so these are our 4 entries. Let's see what they look like in our T accounts. So remember, we started retained earnings with our beginning balance. Our beginning balance came from our adjusted trial balance, and that's the amount that was carried forward from last period. All right. Then we close our revenues into income summary. We close our expenses into income summary. That gives us a balance in our income summary that is equal to net income. Then we're going to close our income summary to retained earnings. We're going to close our dividends to retained earnings, and that gives us our ending balance in retained earnings. So our beginning balance plus net income minus dividends gives us our ending balance. And the ending balance in the retained earnings goes to our balance sheet, and it also goes to the next thing that we're going to look at, which is our post-closing trial balance. So notice that we started this closing process with our beginning retained earnings balance from our adjusted trial balance, and we're ending with a different retained earnings balance that goes off to our balance sheet, which is our ending balance. All right, so as promised, we're going to have another trial balance, a post-closing trial balance. So after all of the closing entries are prepared and posted, we're going to prepare a third trial balance. It looks very much like the other trial balances. This one's called post-closing. So we had, remember, unadjusted, adjusted, now we have post-closing. The only things left here are our permanent accounts. All of our revenues, expenses, and dividends are gone, right? You don't see them there. Where are they? They're in our ending retained earnings. So the 3550, remember, is our ending retained earnings. Very important. And that's what makes this balance, because we took all our revenues and expenses and dumped them right there into our retained earnings. So now we have finished the accounting cycle. So you've seen a lot of this before, but let's just review. We start the beginning of the period with our account balances. Transactions happen during the period. We analyze them and journalize them, put them into the journal, right? Debits and credits. Then we post the journal to the ledger. We prepare an unadjusted trial balance, which is our first trial balance. Then, remember, we did the adjusting entries. We did those in Chapter 3. Those are a little tricky, remember? So we journalize and post our adjusting entries, and we prepare our second trial balance, which is the adjusted trial balance. Now, the adjusted trial balance is important because those are the numbers, those are the correct adjusted numbers that we use to prepare our financial statements. Quick review, we have our income statement, revenues minus expenses is net income. Then that flows into our statement of retained earnings, beginning retained earnings plus our net income minus our dividends gives us ending retained earnings. And the ending retained earnings comes down here to our equity on our balance sheet, where assets equals liabilities plus equity. So once our financial statements are all prepared, then we journalize and post the closing entries. That's what we just did, where we closed our revenues, expenses, and dividends. Then we prepare our third trial balance, which is our post-closing trial balance. And that has all of our permanent accounts on it, and those balances become the beginning balance for the next period. So that is the entire accounting cycle, and it goes round and round and round over and over again every period. All right, so that's all I have here. We don't have any other videos for this chapter because there wasn't a lot of things that we didn't include in this video here. So hopefully this is giving you enough to do what you have to do. Of course, your guided notes always have a lot of exercises for you to practice, and that's the best way to learn this. So make sure you go through your guided notes and practice, practice, practice. See you next time.